Upstart, the AI lending platform, is getting more interest from investors as the central bank in the United States is beginning to cut interest rates. And I can understand the case for that. This company is highly correlated to interest rates, and as interest rates decline, it should be a significant positive for Upstart. But the share price is down over 12% in the previous month, while the S&P 500 is up almost 3%. So it's still not catching those positive sentiments reflected in the share price. So I'm going to discuss a little more about what's going on with this company and provide my outlook and give you details about its performance.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in the most recently completed quarter, the company delivered excellent revenue growth above 100%, and the management team, the CEO, Dave Gerard, highlighted that the growth was primarily on the back of model improvements, which helped to drive conversion rates from 19% in Q1 to 24% in Q2. So if you didn't already know, Upstart uses artificial intelligence to make lending decisions instead of just using traditional models which rely almost exclusively on credit scores to make lending decisions. So their model aims to provide innovation in the category and disrupt the category. And already they've made significant inroads, and this model improvement helped improve conversion rates from 19% to 24%. Conversion rates discuss the rates of how many people are applying for loans on the platform and how many people get matched with loans on the platform. And as I've been saying before with lending companies, there is no shortage of borrowers. There will never, in the history of humanity and in the future of humanity, will ever be a shortage of borrowers. You can always find people that want to borrow money. Never, ever, ever will there ever be a shortage in that category. But for lenders, you don't just want to lend money to anyone. You want to qualify these borrowers and you want to make as certain as you can and do as much diligence as possible to determine who's going to pay you back. Because a lot of borrowers, if you just lend money to everyone, you're going to have a lot of people not pay you back and you're going to lose your money. So, what's driving the improvements in conversion rates is lenders becoming more confident that these borrowers will generate a sufficient return on investment. Of course, you're always going to have some defaults, but lenders became more confident that the defaults overall will not be too large compared to the money that they're lending and the interest they're getting in return for making these loans. So these improvements came first and foremost from their Model 22, which they launched in early May. And those advancements are working well. And that's always good to hear when a company that's innovating in the category is learning and innovating at a faster rate. So these are technology-driven economic wins that result in product for consumer and a sustainable advantage for Upstart. And that's true. When you're making gains based on improvements in your technology, that's more sustainable than if you're making gains based on a change in something in the economy, like I talked about in the introduction, like lower interest rates. Lower interest rates might benefit Upstart to be sure, but those benefits are not as long lasting as benefits resulting from improvements in technology, which can allow the company to gain market share and grow revenue in any economic scenario. So those improvements are much more attractive for investors than improvements as a result in declining interest rates. So the management team said that small dollar loans and auto loans each crossed 100 million in quarterly originations, and they expect home loans to follow soon. Their newer products drove almost 20% of new borrowers on the platform. For each of these emerging segments, they're now reaching the point where credit history is sufficient and volumes are substantial enough for third-party funding. In fact, they have a goal to transition most of the funding to these products off of their balance sheet by the end of 2025. Though deal timing is always hard to predict. So let me talk about the last part of this statement first. Third-party lenders have become so excited about this category in recent, I want to say, in the last 2 years or so. they've really leaned into this category because interest rates are so elevated, right? The central bank is holding interest rates above 4.5%. So government bonds are bringing in almost 5% on a 30-year rate. So if you're a personal loan borrower, you're paying at least 10%, sometimes closer to 20% or 25% for borrowing money. And so from a lender perspective, you're thinking, man, I can get 10, 15% for making loans. This is not investing in stocks or cryptocurrencies. These are loans. Loans generally are less risky than stocks or cryptocurrencies or other types of equities because the returns on loans are more well defined, and historical figures allow lenders to calculate, the number of people that will default and how much money you will lose in the event of default. And so the outcomes are more well defined, which lenders like. Lenders are more risk averse than equity stock investors. So all of that has worked well, and lenders have been very interested in making these loans, and they really leaned into this category. Additionally, Upstart is making progress in collecting data, but I will make a note here. I will make a big note here. Even though they're collecting a lot of data and they're getting a lot of credit history, and all of that is great. The one thing that's been missing for Upstart, and it's no fault of their own, there isn't anything they can do about this. At least I don't think there's anything they can do about this. The company has not been through a meaningful economic downturn, like a recession in the United States that results in a big increase in unemployment, so that they can have that data. What percentage of the people default on the loans that they made, and what were the losses on those loans that they made through an economic recession? Until they get that data, I think there's that big risk for investors in Upstart and lenders on the Upstart platform compared to, traditional lending models from banks and other financial institutions that have decades of data and several economic recessions of data to understand what the defaults are during a recession, because that's really when it matters, during a recession. When economic times are strong like they are now, unemployment near 4%, you're not going to get very large percentages of defaults. And so it's not that meaningful, the accuracy of your lending models during good economic times, because those figures are not indicative of what the return on investment will be for lenders as they go through an economic recession. That's when people lose their jobs. That's when people default on their loans most significantly and more frequently. And that's the data that Upstart desperately needs. And unfortunately, you can't get that data without going through that difficult situation, which hopefully doesn't come anytime soon, right? Nobody wants a recession. Well, I shouldn't say nobody, but I certainly don't want a recession anytime soon. Upstart certainly doesn't want the recession anytime soon. But until the business goes through one and collects that data from its borrowers on the platform, investors will have that risk outlying about the company's model in making lending decisions. But that can also be a huge upside, right? Imagine they go through that recession, and the borrowers on the Upstart platform that were on the Upstart platform that borrowed based on the metrics that Upstart used, imagine those outperform the legacy methods from other financial institutions that use credit scores, et cetera, to make those lending decisions. If you get that data back and it's positive, and it's even anywhere equal to the financial institutions, the banks, if it's anywhere equal to that, there will be a huge boom for Upstart and a huge influx of lenders on the platform, because their loans are significantly less costly to originate. It's more digitized, less human involvement, and so lower cost and more convenient for borrowers and lenders. And so that's the big upside and also the big risk for Upstart stock investors. Still, even at its current place, I upgraded Upstart stock to a buy today. It's the first time I've had this stock rated as a buy in 5 years or so. More than 5 years I've been following this company. And so I made this upgrade based on the improvements they've made and the improvements I've seen in the business already. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.